What if I told you there's a way to earn supersized dividends in today's market? Well, YieldMax ETFs claim to make that possible, but how do they do it? And is it too good to be true? Fasten your seatbelts, folks. This is going to be a good one. If you're in the hunt for big dividends, you have more than likely come across YieldMax ETFs. They have some of the biggest dividend yields out there for sure. Of course, that first question that probably comes to mind is, how exactly can they do it? We are going to look at their unique strategy that may just put them ahead of the rest. Of course, we're also going to take a look at their risks. YieldMax is a specialized ETF provider focused on delivering high income through innovative options strategies. Unlike traditional covered call ETF managers, YieldMax uses a unique approach that centers around synthetic covered calls to generate consistent high yield payouts. Their offerings often target specific stocks or indices, making them a go-to for income-focused investors looking to maximize that cash flow. So what the heck is the synthetic covered call? In a slightly complicated nutshell, they are a method for generating income that begins with creating a synthetic exposure to an underlying asset without directly owning it. For example, if you're looking at MSTY, good old Misty, they don't actually hold any MicroStrategy. Instead of buying shares outright, YieldMax employs a combination of long call options and, of course, short put options. This pairing mimics the performance of owning the asset, allowing the ETF to track its movements while freeing up capital for other strategies. Once that synthetic exposure is established, they can then employ additional covered call writing strategies over top of it. Here's how it works. The ETF sells call options on the underlying asset synthetic position. These options give buyers the right, but of course not the obligation, to purchase the asset at a strike price by a specific date. In exchange for selling these options, YieldMax collects premiums up front. These premiums then form the bulk of the income that powers the ETF's high yield dividends. Okay, to get just a little more geeky, the type of options they focus on are typically short-term at the money or slightly out of the money calls. Those are terms you may not have heard me use that much before. So at the money basically means their strike price are close to the current market price. While out of the money, those ones have strike prices pretty much above that current market price. So in this case, at the money calls allows them to maximize the premium collected, while the slightly out of the money calls, that can strike a balance between income generation and allowing modest upside potential for the underlying asset's performance. The result is a steady stream of income that's distributed to investors in the form of high yield dividends, often reaching a double-digit annualized payouts. As tempting as those high yields may be, YieldMax ETFs are not for everyone, as there are some risks or considerations you may want to take a look at for sure. Because they sell call options, these ETFs cap their potential gains. If the underlying asset performs exceptionally well, investors won't capture all of that upside. Synthetic covered calls can be highly sensitive to market movements, especially during periods of volatility. If the market drops significantly, the value may also decline as well. The high yields come from the premiums earned on option sales, but these premiums aren't guaranteed. Factors like market conditions, volatility, and liquidity can affect the ETF's ability to generate income. In fact, when you look at these dividends over time, you will see that they're moving quite a bit, and this is kind of where this all comes into play. A sub to the channel is a no-risk way to ensure future content. At the time of recording, we have 38 of these ETFs, which is way too many to highlight, so we will look at the top 10 in terms of yield. For this list, we are sticking to single companies and also not including the shorting ones, because there's a couple of those out there for sure as well. We are also sorting them by their total returns from the last year. If you are looking to see the ones that did not make today's list, just head on over to their website, YieldMaxETFs.com, to check them out. So, without any further ado, let's do this. Coming in at number 10, we have SMCY. Now, this one, it tracks Supermicrocomputer, SMCI. They do have a nice looking yield of 90.50%. However, when we look at their returns on their 1 year return on investment, it comes in at negative 37.20%. Factor in the dividends, we get a total return of negative 22.27%. Oh boy, that's not great. That's not great. But Super Microcomputer, of course, they had some big issues this year, so that certainly contributed to these dismal numbers. Moving to number 9, we have AIYY. This one tracks Atrium Mortgage Investments. They have a ticker of AI. Now, this one does have a really high yield of 106.63%. However, looking at their returns on that 1 year return on investment, that does come in at negative 48.66%. Factor in the dividends, we're still in the negative 12%. This company absolutely has struggled in the first part of the year. Things are starting to look better, and hopefully they can improve on some of these numbers. All right, let's move to number 8, and we have TSLY. So this, of course, is the Tesla one, ticker TSLA. It has a yield of 92.65%. Looking at their return on investment on that 1 year, we get negative 28.25%, but their total return after we add in the dividends, we are the positive finally on the list, 11.56%. Tesla absolutely has exploded in the second half of the year, and I expect them to be much higher on this list. Even 6 months from now, they might be up near the top the way they're going lately. Coming in at number 7, we have SQY. This one tracks Block, which has a ticker of SQ. I guess SQ probably makes me think a square, and a block is a square. So, yeah, I guess it makes sense. Their yield comes in at 109.3% on their returns. That 1 year return on investment comes in at negative 19.52%. Factor in the dividends, and now we're starting to see some half-decent total returns, 23.19%. So this one's pretty good. Coming in at number 6, we have SNOY. This one tracks Snowflake Incorporated, which has a ticker of SNOW. Those of you who don't know what Snowflake Incorporated is, they are a software company. They mostly specialize in cloud computing and data centers. Their yield comes in at 113.37% on their returns. On their 1 year return on investment, that comes in at negative 2.88%. Total return, 23.73%. Moving into our top 5, we have AMZY. This one, of course, tracks Amazon, which has a ticker of AMZN. They have a yield of 75.50%. Looking at their return on investment, their 1 year return on investment comes in at negative 5.25%. Factor in the dividends, total returns, and we're getting more respectable here, 35.12%. Coming in at number 4, we have Coney, or CONY. This one tracks CoinSquare with a ticker of, well, COIN. They have a yield of 110.74%. Looking at their returns, their 1 year return on investment, it's dismal, negative 39.69%. But they make up for it with their dividend. It brings that total return up to 38.37%. All right, we are now in the top 3. At 3, we have NFLY. Of course, this one tracks Netflix, and they have a yield of 60.30%. Looking at their return on investment, their 1 year return on investment comes in at 3.48%. Factor in the dividends, we get a total return of 53.75%. That's not too shabby. Coming in at number 2, we have NVDY. Of course, this one does track NVIDIA, NVDA, and they have a yield of 66.12%. Switching over to their returns, on that 1 year return on investment, that comes in at 5.80%. Total return after we add in the dividends, this one's looking pretty juicy, 94.39%. All right, that leaves us with our number 1 fund from YieldMax. And I think this one's not going to be a surprise. It's MSTY. They track MicroStrategy, so MSTR, and they have a mind-staggering yield of 152.62%. Holy banana bread. Looking at their returns, and these are crazy as well. Their 1-year return on investment comes in at 84.40%. We add in those crazy dividends, we get a total return of 204.26%. Oh boy, that's not too shabby at all. Overall, when it comes to YieldMax, some of their top yields, they performed like a dream. Well, a few have not quite lived up to that hype for sure. In all fairness, as markets change, a lot can also change with these rankings. But for now, as the bull market continues, I have a feeling some investors will do very well with some of these funds. Of course, if you are a conservative investor and these funds scare the banana bread right out of you, there is no shame at all in sticking to safer waters. One other thing you should definitely keep in mind with these funds is that their dividends will be the victim of a 15% withholding tax. Hello, IRS. Unless, of course, you hold them in your RRSP. You can get some of it back in a non-registered account. But if you're holding them in your TFSA, that 15%, it is, well, yeah, it's gone forever. If you are interested in any of these YieldMax ETFs, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on, well, MicroStrategy. Thank you for watching, and I will see you in the next video. Alexa, stop.